Hello and welcome to another edition of the bonus Mouthy Money podcast. I'm joined today by Chris Stute, who is head of consumer finance at MRM, and we have got our first ever guest on the bonus episode, Tom Selby. Welcome.
Thanks for having me. An honour.
So, as our first guest, we've got you on to talk about a specific topic today, and this has been a little while coming because we wanted to talk about it for a little bit, but it just so happens that the company that Tom works for, AJ Bell, a big investment platform in the UK, has submitted some proposals around ISAs to the new government. Now, Tom, when we asked you to come on initially, we wanted you to talk about the UK ISA is its official, unofficial name, being dubbed in the press the Brit ISA. And I mean, without putting too fine a point on it, the main reason why we wanted to speak to you about it is because we all wanted to basically dunk on it a little bit for being a not an excellent idea. Now, I listeners might not be kind of 100% clued up on what the Brit ISA, UK ISA is. Do you want to just explain it to us in a nutshell, and then we can kind of go into the reasons why, we're not that best pleased by it?
Sure, thanks, Ed. So the UK ISA was the previous government, or part of the previous government's answer to the challenge of capital markets struggling for money. So new businesses in the UK need funding. It's a big part of the growth agenda, and the government's been trying to use partly pensions to try and address that problem. And then they looked at ISAs, and some other people outside the industry, I think, looked at ISAs and said, maybe we can use ISAs to try and solve that growth problem as well. So the idea was to create a new type of ISA, as you say, the UK ISA or British ISA. It seems to have two different names, with an extra £5,000 of ISA allowance. So you've got the overall allowance at the moment is £20,000. You would potentially have an ISA allowance of £25,000, but that extra £5,000 would need to go in as yet undefined UK companies and UK funds. So that was broadly the proposal that was put forward. Now, it was consulted on before the election. The election was actually called before we'd reached the end of that consultation process. So it's all slightly up in the air at the moment. But as I'm sure we'll get to talk about, the Labour government in January said they're in favour of ISA simplification. So we're hoping that, given that the UK ISA would add quite a lot of complexity to the system, a seventh type of ISA, and there'll be loads of complexities around introducing it as well, that proposal's quietly going to be shelved, and we can have a slightly more sensible conversation about how to deal with some of the challenges of UK capital markets and 2 decades of anemic growth, which is clearly, understandably, a problem that both the previous government and the current government now are wrestling with.
So that's kind of one of the bigger, setting aside the kind of, we need to invest more in the UK and we've got to fix capital markets and unlock investment, all that kind of stuff. There's just basic practical problems with having an ISA, which is basically forcing people, not forcing people, but only giving the opportunity to invest in UK assets, right? Because it's like, what do you mean by a UK asset? If it's something that's a stock market listed, could I just go and invest it in Scottish Mortgage Trust, which is on the UK market, but has very little to do with UK investments and that kind of thing? That's one of the kind of the key problems, right?
Yeah, one of the big challenges, one of the many big challenges. So I think the idea was put forward at ministerial level. I think you can see why, if you're presented with that as an idea, like what could the problem possibly be? We've got a problem, not enough money going into the UK. Solution: create this extra £5,000 of allowance, and people can shovel more money into the UK, and that will help overall the economy. As you say, the challenge is, first of all, in defining what is and isn't UK. So they were talking about potentially, so in order for that idea to kind of fly, you would need presumably to include all different kinds of funds that invest in the UK. As you say, you'd also need presumably to include investment trusts. But as you say, you've got things like Scottish Mortgage, that is technically a UK listed company that invests all over the world. So that doesn't seem to be aligned with the policy intent. If you allow the Scottish Mortgage Investment Trust in a UK ISA, then you could actually make an argument that every single fund that exists should be included in the UK ISA, at which point you just say, why don't you just increase the ISA allowance to £25,000 rather than £20,000? I think almost more problematic than that issue around definition was firstly the complexity point. So we've argued for a long time that complexity puts people off using ISAs, which has generally been a successful product. Actually, the government seemed to agree with us back in September of last year, and then they decided to announce introducing a new type of ISA. So there wasn't any real clear thinking going on there in terms of ISA policy. But one of the real challenges was that if you create a UK ISA, you would need to wrap it around with so much regulatory compliance communications to make sure that people don't do the wrong thing. Because objectively, anybody who's investing within their first £20,000 during the tax year would be better off investing in a stocks and shares ISA rather than a UK ISA, because you've got access to exactly the same investments and more besides. And any UK ISA would, by its very nature, have to have transfer restrictions imposed upon it, because otherwise you'd have people filling up their UK ISA allowance and then just shifting it into a stocks and shares ISA, and the whole aim of the policy would fall down. So you'd end up with these complexities around the design of the product. You'd end up with either people making poor decisions by investing in a UK ISA rather than a stocks and shares ISA, and we did some research which suggested that a lot of people would do that purely because they don't understand the difference between the two. And so you'd end up with hugely complicated communications and risk warnings around this product, to the point where I suspect the maximum that was going to go into UK companies as a result of this was somewhere in the region of 3 to 4 billion. I suspect it would have been a fraction of that amount of money once you'd wrapped in all those risk warnings, once you'd had all these transfer restrictions in place. So from moving from a place where the government said we want simplification, we'd gone to a place where not only were we creating a new type of ISA, which we didn't think was going to achieve what the government wanted to achieve, but it was also going to add whole layers of complexity beneath the product as well, to make sure that people didn't make daft decisions which would inevitably happen.
Chris, you're the communications expert in all this, and I'm guessing that complexity, delivering that message to people, it becomes so hard with that complexity, right? So I'm guessing you're probably in full agreement with Tom here.
Yeah, the simplification point is hugely important. It is difficult because we've been building upon various different legacy platforms and technologies and ideas for a long time now. It does feel like, we touched on it a lot on this podcast, Ed, about just the tax system, for example, and this is another area where perhaps it's starting to become a bit grotesque in terms of the number of bolt-ons, and getting back to basics is the right thing to do, I think. The questions for me around it are, how do you? It feels like it's a restart moment, a kickstart moment. It's interesting that Labour's come in and talked about this National Wealth Fund, for example. There is a need to get the UK stock market firing again. I think I saw earlier this year that the amount of money the amount of new companies raised 12 billion on the LSE in 2021. Apparently, that fell to 338 million in 2022. It has dropped even lower in 23, and it's looking like it will stay low in 2024. So there is a clear, tangible issue there about how do we get people re-engaged with their home market. I think, Tom, you touched on an interesting point, though, which is most people in the UK tend to bias towards that anyway.
Yeah.
So how do you kind of harness that and make that a virtue and take people with you? And a lot of good marketing and PR and comms is around this idea of come with me in a direction, and you can galvanize people into making good decisions. So the stage we're at this point, I think, is creating the infrastructure where we're able to do that effectively and people get good outcomes, with obviously the consumer duty knocking around in the background. But also there is a chance here to kind of put wind in people's sails that they're doing something to change things around them. I think there's apathy swept across the country in recent years, post-COVID in particular, this idea that it's political apathy. You can perhaps see that in the election turnout, but there's also kind of a personal apathy about being able to change your own situation. And so the idea here that you can help your country directly by investing money into this, as well as doing other things. We don't want to be too narrow of focus, but I think I'd be willing to do that if I felt that it was going to improve the economic situation more broadly. I think I see the benefit in that as just a consumer, taking off my comms hat for a minute. I think the one thing where I get a little bit I mean, I've read obviously what you guys have said, Tom, and raising the ISA allowance to 25,000 seems good on paper. I think that's a good idea in theory, but in practice, actually, that might seem a little bit daunting to people hitting that kind of target. And that doesn't mean you shouldn't have that flexibility within there, but the idea that that's just an unobtainable number sort of knocks around in people's heads, I think, and therefore money might end up being put into other areas that aren't necessarily going to work to the benefit of those individuals. So maybe thinking about staging points or ways of changing the communication around that. So instead of having this far off target of 25,000, which is relevant to certain people, you could have, steps along the way that would encourage people to hit different milestones as they go. And I think that potentially might even create even more engagement with it. But all in all, I think, we need to do something to deal with these issues. And your suggestions about simplifying the regime and getting back to basics, I think, is a good message that spans not just personal finance, but politics, wider economics. We need to get back to what's kind of important. So Ed, broadly speaking, I think it's the right call.
Yeah, just to say, I couldn't agree more, Chris, with what you say there. I think, firstly, on the point of the genesis of the UK ISA and what the previous government was trying to achieve there. As you said, we're talking about growth challenges and flows away from the UK that have been going on for 2 decades. So the idea that you can announce some sort of gimmick that's just going to shift that overnight is for the birds. So moving the conversation generally to a place of how do we set the foundations for long-term economic growth and accept that no one individual thing is going to change something that's got such deep roots within the UK economy. So the new government's come forward with planning reforms, and that to me suggests that there's more of a long-term focus on this problem, because you like I say, you're not going to be able to solve this overnight. There's no one type of ISA product that's going to be able to solve this. ISA simplification isn't going to solve this, clearly, but it's about doing the things that you can do in order to create an environment where people want to invest for the long term, and trusting the fact that over the long term, and I'm talking really here about at least a decade, over the long term, things will start to shift and things will start to move in the economy. I think the challenge with the previous government was there was a sense of desperation about what they were trying to do, just trying to throw enough excrement at the fan and just seeing what sticks. And in reality, that was never going to work. And actually, the danger is that you end up doing more harm than good by ramping up the complexity that investors face. And we all know that investors hate that sort of thing. There's so much behavioral economics research out there that says you have too much choice, too much complexity in front of people. And what is already quite a difficult, intimidating decision for a lot of people becomes even more intimidating, because they're like, crikey, I've got 6, potentially 7 different versions of ISAs I need to make a choice from. I'm already quite scared of making this choice. And now I've got 6 different versions with different names, different allowances. I'm just not going to bother. I'll just shove my money in cash. Thank you very much. At least I know what I'm doing. So a shift towards a longer term strategic approach to the challenges we face, I think can only be a good thing. So I'm hopeful a new government will give us a fresh start and some fresh thinking on that.
Yeah, I think you're one of the phrases in the report that accompanied your announcement this week, Tom, was analysis paralysis, and that's definitely a factor. I suffer for that myself.
Yeah, same.
I put some money into my SIP recently. Oh, it's quite a big wedge. I've got sort of various diversification going on. I know we're talking about ISAs here, but the point will stand. Bear with me, gents. There's a few £100 there that's just sat in cash, and I'll get to that in a bit, and I'll work out where I'm going to put it. And then actually, I might need to do this, or I need to diversify that, or should I put it into one of my existing funds? And all of a sudden, 4 months have gone by, and I've done absolutely nothing with it. And this is somebody who engages on a weekly basis, has a conversation with you, Ed, about what I'm going to do with my money. So if you're living a busier life and this isn't part of your day to day, then it's just going to completely disappear out of view, and before long, it's kind of sat there for ages and it's doing nothing. I think simplifying the message overall about why you're doing it and this kind of long-term focus is important. We need to do that within the idea of, good customer outcomes, and everyone has different time horizons and all that kind of good stuff. All of that needs to be carefully stage managed. But again, I go back to the point about good communications, good PR, good marketing is come with me on this journey kind of thing. And there's an opportunity here to draw a line in the sand and say, right, we're going in a different direction and you guys can play your part. And if they have that simple idea in their heads, consumers have that simple idea, or investors have that simple idea in their heads, that the reason we're doing this is for the greater good and for my own personal good, and there's going to be good outcomes that come from it, I think they will come with you. But we have to make sure we're clear on what the ask is, and that's where your paper comes in really handy, Tom. I think it's a good starting point for that.
So let's look at the proposals then, because I think that they are really, really interesting, and coming at, it's obviously coming at a very important moment where government's just getting its feet under the table kind of thing. So when you look at the landscape of ISAs now, it is a mess. So you have stocks and shares ISAs, cash ISAs, lifetime ISAs, junior ISAs, take a breath, innovative finance ISAs, a help to buy ISA, and then this theoretical notional UK ISA on top, which would be 5, 6, 7 different, basically bits and pieces to it. And I think the point there was the reason why the ISA was so successful in the first place, and the reason why we have a phenomenon of ISA millionaires, people who have more than £1 million in an ISA, is because when it was introduced, it was one thing. It was simple. It was straightforward. You knew the allowance. You knew the limits. You knew that you weren't going to face any tax when you put money in there. And that's all you needed to know about it. And now it is a mess. So, Tom, tell us what is AJ Bell's kind of basic proposal here? What are they? What do you want to see happen?
Yeah. So our central proposition is that we think that the fact that ISAs have started to move to a world where each version of an ISA is defined by what you can invest in. That's quite weird. That you don't have that in pensions. So if you've got a pension, pensions have got their own complexities, of course, but you have a pension and you invest in the stuff that you want to invest in. With ISAs, we've moved to this world where the way that an ISA is defined depends on how you invest your money. Now, we don't think that's necessary. We think that actually in relatively straightforward fashion, you could combine the best versions of most of the existing active ISAs, and then move from a world where you're defining the ISA by what's invested in it to just saying the ISA is the tax wrapper and the provider chooses things that you're allowed to invest in based on all the rules and all the rest of it. So our initial version of this paper, so this is the second version of the paper, our initial version of this paper pushed for what we called a one ISA. So that would have been incorporating all the different types of ISAs that exist at the moment, including the lifetime ISA, which has a bonus element attached. Now, we still think there's an argument for looking at that in the long term, but pragmatically and practically, including the lifetime ISA within a single product is more difficult. So firstly, it's not really an ISA. It's got a bonus element attached to it. So you'd have to hive off that bonus element and have that separate within the account to all the other ISAs that you have. If, as a provider, you were to allow lifetime ISAs and stocks and shares and cash, for example. So there's a practical difficulty there. I think there's also a political difficulty as well in that the lifetime ISA is the offering to young first-time buyers. And we can see why, as a politician, having something that's separate, that is your offer to younger people who are struggling to get on the housing market, which is one of the biggest challenges facing society, is an attractive thing. So in this version of the paper, we've said, okay, if the end result is we have a lifetime ISA separate, and then we move to having an ISA which you use for cash and investing primarily, and then a lifetime ISA which is something slightly separate, then that would be a significantly improved position from where we are at the moment. It's not perfect, but it would be a significant improvement on where we are now. And we think that can be achieved in relatively simply, although obviously there need to be a consultation to go through the details and to kick the tires and to make sure there aren't any huge practical challenges. But we think it's doable, and we think it's something crucially that can be achieved by the government at pretty much no cost to the government. Now, clearly, if you increase the ISA allowance, there'd be a bit of a cost, but if you just kept the ISA allowance at £20,000, simplified the architecture, then the cost of the exchequer is going to be almost nothing, and it would simplify the choice for investors, so it'd be good for investors, and crucially, it would play into this whole UK capital markets focus of the last government and this government, because when you're starting off investing, you're investing in cash. If you reach the point where actually you're ready to take that next step, you've got your rainy day fund set up and you want to invest for the long term, then you don't have to open a whole new product in order to do that. You could just do it within the same tax wrapper. So that's the proposition. We think the prize is actually potentially quite significant. So there was some HMRC data that was published recently that suggested there were about 3 million people who've got 20 grand or more invested in cash ISAs who have nothing invested in stocks and shares ISAs. So even on a relatively conservative estimate, if say those people needed 10 grand to be their rainy day fund, and then the other 10 grand could be invested for the long term, obviously in line with their goals and their risk tolerance and all the rest of it, you're talking about potentially an extra £30 billion there being invested. And as you said, most people tend to exhibit a home bias anyway, so the UK would disproportionately benefit from those changes. So it's about setting in place a simpler, more logical structure for ISAs, where it's based upon where the kind of main ISA product isn't defined by how you invest. It's just defined as an ISA product. Then you choose your investments beneath that.
So I wanted to ask about the cash ISA element of this kind of, theoretical one ISA proposal, because I mean, there's still a role that cash can play, be it, as you mentioned there,
Absolutely.
for kind of a rainy day fund, or, perhaps for an older investor who wants to de-risk slightly.
Mm-hmm.
And, look, cash rates are pretty good at the moment. You can still, on a 5-year fix, get over kind of 4%, which, over 30 years is still beating average and kind of long-term inflation levels. So you're still coming out ahead, more or less. So in practice, because the market for cash ISAs is pretty broad. There's lots of choice, lots of banks. How would you see that functioning in practice if you've got one ISA? Does that end up with, because to me it sounds a bit like it ends up with investment platforms gatekeeping the cash ISA rate market a little bit? How would you see it working in practice?
So, really important point, and I think absolutely candidly something that in the first iteration of this we perhaps didn't quite communicate well enough to either the industry or to government or HMRC. So the way that we're setting up or proposing that this reformed simple ISA would be set up, if you're a cash ISA provider today and you don't offer anything else, then on day one of moving to this simplified structure, you would be able to offer exactly the same investments within what's just called an ISA. You could still market those investments as the best cash rates in the market. There would be no discernible change to what you're able to offer. All it would be that it would be called an ISA rather than a separate cash ISA, and that provider, if it chose, would be able to start offering investments, stocks and shares, funds within that same product. Now, I think over the long term, what we would hope would happen, and what you would expect to happen, is that some providers that specialize in stocks and shares investments at the moment would start to offer more competitive cash, either banks or building societies within that product, or cash equivalent rates. There'd be more competition on that front. And you'd also expect from the other side as well, banks and building societies who perhaps focus on cash at the moment might see an opportunity to offer longer term investments to people because they can hold that all within the same tax wrappers. So we see this as being an enabling reform rather than being anything which fundamentally changes the options that are available to people, and crucially the way that those options can be communicated and marketed to customers as well. So if you're Bank A and you offer a cash ISA at the moment, then you can still be Bank A and you can still offer a cash ISA with a market leading rate. And there'd be no need, as far as I can see, for that to change under the reforms we've proposed.
No, that's interesting. Chris, you've got actually personal experience of this, haven't you, of kind of the chopping and changing between stocks and shares and cash and, where's the best place and that kind of thing.
Yeah, I think so. We were talking off air, actually, Tom, about I'm a bit weird. Let's get it out there. I'm a bit weird, right? So I work in financial services, and I know that, you don't. My rainy day fund keeps coming up on this podcast because we had a massive resetting of what constitutes the amount you need to keep your head above water, because the rain seemed pretty heavy, to stretch the metaphor. So I've got quite a lot of money sitting in a decent cash ISA with Synergy Bank, where I'm quite happy with the returns that I'm getting there. But I've also got a stocks and shares ISA set up with, sorry to say it, Tom, but with Hargreaves Lansdowne.
I'll let you off.
Maybe we can change that. Anyway, and I put some money into there, and then just saw that it was kind of stagnant for a while, and have ultimately decided to redirect the money away because, again, I've got this kind of paranoia thing that I think stems from deep issues in my childhood, which again we won't get into here, where I feel like I need a larger kind of rainy day fund to kind of tide over, particularly with a lot of moving parts happening in my own personal finances. Again, when we talk about the fact that I'm remortgaging soon, I've got another child on the way, things like that, where you'd like, okay, I just want the safety of having the money here. So I think I might be more amenable in next year to a conversation about redirecting some of that rainy day fund once I'm over those milestones back into something. It would be more. The question then is what that investment looks like. And one of the things that kind of comes up is if you look at the performance of the US stock market, for example, or sorry, I know there's more to it than that, but I think trying to find the figures here, but there was the performance. Oh, that's it. Here we go. So the Nasdaq has massively outperformed. Basically, I think it's 50 odd % compared to the London Stock Exchange, which was about 7%. So the question I kind of have then is, while I like the idea of piling that money into the UK for all the reasons we've identified before, and I probably would put some of my money into it, I also think there's a question here around kind of performance and what to do with it and how to kind of push it out there, and also trying to get over this fear of what how big my rainy day fund needs to be. So yeah, I don't suppose there's an answer to that, Tom. I think that's just me kind of outlining some of my my own kind of personal biases against the idea of the stocks, putting stuff into the stocks and shares. And I know the power of the markets through my SIP and through other things here, but I think I would need a gentle encouragement to do with it. And this is why I've talked back to do it. And this is why I've talked about this idea of setting a vision about where we're going and what you're putting your money to work to do, and putting all that kind of additional information and around it and keeping the message simple, I think would encourage more people like me to take that plunge. Or there needs to be a conversation about what your rainy day fund looks like now. And while it's different for all sorts of different people, I think actually setting different limits on that and maybe being a bit more specific around that might encourage people to loosen the purse strings a bit more and to take themselves off their cash addiction. I don't know. So it's an interesting thing, because psychologically, I can see all the logic of what you're saying completely. Psychologically, I think I probably need a little bit more reassurance on a variety of different things settling down around me before I actually did start to put that money to work in that way.
That's a totally fair challenge, and I think there's without dragging the conversation elsewhere, there is a broader debate to be had about what government can or can't do to encourage people to have more financial resilience by having a cash savings pot, a rainy day pot. So as you say, Chris, you're quite weird. So you take responsibility for these things. You're being very sensible. Most people aren't very sensible. We saw all of that during the pandemic. And actually, while automatic enrolment has been broadly a success in getting more people to save for retirement, and it's a good thing, and we agree with that, that there is just logically, it was slightly the wrong order to do things in. So normally when you're talking about financial planning, if you're saying to someone what you're going to do with your money, the first port of call is paying off any high cost debts, as you guys will know all too well. And the second port of call is building up a rainy day fund. And actually the previous Labour government, in introducing auto enrolment, kind of skipped those two bits and went straight to the saving for retirement bit. Now, I think I understand why that happened, because there was a huge crisis in retirement saving coming down the track. But that bit of building financial resilience and a rainy day fund was slightly forgotten about in all of that, and exposed by the pandemic, and then exposed by the high inflation that we've seen since then. So I expect that will be a focus for the new government. I think they're looking at things like savings sidecars to go aside automatic enrolment. So this idea that you've got your auto enrolment pot, and then perhaps you have some money automatically enrolled into a cash pot as well. I think that sounds quite sensible to me, and something which you'd expect them to push ahead with. But there's all sorts of different challenges facing the government. And I think your point as well around communications, and going back to what you were saying about having these big numbers and breaking them down for people into simple numbers, I think it's a particular challenge with retirement. So you look, again, slightly dragging us away from the topic here, but you look at the retirement living standards that have been put forward by the Pensions and Lifetime Savings Association. Again, I think generally a good thing, but when I speak to my mates and I end up dragging them into a conversation about retirement saving, and they say, how much do I need to have a comfortable retirement? And I end up giving them a number that's pretty close to £1 million. they just throw up their hands and say, oh, that's absolutely impossible. And so breaking, whether it's that full retirement number or even trying to say, fill up your ISA allowance, breaking it down into little bits over time and explaining the benefits of doing that, I think is hugely important. And hopefully the reforms being looked at around the advice guidance boundary will help with all that as well.
Yeah, that big number apathy is a major thing. Like, and Ed, we
terrifying.
talked about it. We talked about it, haven't we? About your use of the LISA. It was like, right, I think was it $5,000? Sorry, I'm talking for you here, but having that sort of right, I'm going to hit that target by hook or by crook. It suddenly becomes, and there's a sense of achievement that goes with it, rather than a sense of disappointment that you're not going to be able to hit these numbers. And you build kind of greater financial stability and sense of achievement from it as well, which I think is part of it. Otherwise, you just emotionally, when you get to this, you're just feeling disappointed, disengaged. Everything's unobtainable. Like somehow you're failing. When all of that isn't necessarily true. I think So yeah, I think that finding a way to get that bit by bit message across while we head towards the longer term things are important. Because otherwise, it's just too far in the future, too high, too unobtainable, too obtuse. I'm not going to be able to do it, so I might as well book that holiday or do whatever.
Yeah, I agree, and it's been kind of a hobby horse of mine for the last few years. I think often when people look at financial services, particularly post pension freedoms, when the flexibilities were introduced, the question is, when are you going to create a new innovative product that's going to change people's lives and make turn water into wine? And I've always been of the view that the way we're going to get innovation in the financial services industry that will actually benefit consumers is in the delivery of information and the delivery of guidance and delivery of help to people. I think historically we've been pretty poor at that stuff, but I think technology makes it a lot easier. I think we've got a regulator that is on board with trying to give people more helpful information, and I think that's the area where actually the biggest difference to people can be made, is explaining the benefits of saving for the long term, breaking it down into manageable chunks and things like that. I think the idea that we need lots of brand new products to do those things is it's the wrong area of focus. Actually, we've got most of the products that people need now to build financial resilience. It's helping them understand those products and making sure that product environment is as simple as possible, so that we can give them that guidance and ideally financial advice for those who can afford it, to make the choices as straightforward as possible.
I think just putting it back to that sidecar point, because it's something I remember talking to Nest years ago about the sidecar, and they were very keen on it. I mean, this is a long time ago, they might not be now, but I find it an interesting idea, especially when you think it's like, could we use a product like that where you siphon off a bit of your pension as a short-term, savings fund for emergency uses, take that kind of question out of ISAs of, should I use this for a short-term, cash point of view or whatever? And I find it quite interesting. My one personal issue with the sidecar is I know what I'd be like with that. I'd be tapping that stupid thing up for paying off my credit card when I bought a flight to Cape Town or something, idiotic. And I don't know how responsible I would be with it.
But at least then you can pay it off, though. So you'd still be in a better position than you would be without it. But yeah, clearly there's always going to be the risk if you create any reform which encourages people to build up a cash pot, that they'll raid it like a mad chicken.
No, anyway, it's interesting. I think Chris mentioned there about the kind of the point about the allowance. I think that's the one thing which I've always, and taking it away from the kind of pure tax perspective, and I think we talked about this a bit earlier, is that having that realistic allowance, because it used to be a lot lower. The ISA allowance used to be much, much smaller than it is currently, although that 20,000 limit has not moved for some time now and is in effect suffering from a kind of fiscal drag that, income tax bands are suffering from. So you guys have got a proposal for, obviously, instead of that £5,000 UK ISA tack on, to just increase it to 25 and then make it go up by CPI, right, every year. My question here is how realistic do you think that is with the kind of optics of it, particularly for a Labour government at the moment? Because it is like it's a tax giveaway effectively. Yeah. Are they going to be into that as an idea?
Yeah, fair point. But the answer is I don't know. We'll hopefully find out, I guess, in the coming weeks and months. I think the one thing I'd say is that Labour put growth and wealth creation kind of front and centre of everything that they're trying to do at the moment. And so, if I sense that there's a willingness from Labour to do things that optically might not look like the thing that they should be focused on, if the end result of that thing is everybody being better off and it helping to achieve that goal. As you say, the ISA allowance hasn't increased for a while, so its value in real terms is dropping every single year. But to be absolutely honest, I don't know the extent to which they would be up for that or not. Clearly, money is quite tight, so anything that involves spending any money from the Treasury is going to come up against some pretty serious challenge. But I think our argument was, if you're talking about creating a new ISA allowance just to invest in the UK, then surely the better thing is to simplify and have that extra £5,000 and then just allow people to invest in the way that they choose, in line with their risk appetite, and trust the fact that most people, or a decent chunk of that money, will naturally flow to the UK anyway, because that's certainly what's happened historically.
A strangely hopeful message there for Labour potentially seeing the big picture. I mean, to be fair, like we're what, one and a bit weeks in, and they do seem to be interested in tackling problems that are big problems. So, well, we can hope, I guess.
Well, after the Euros final on Sunday, it's the hope that kills you, isn't it? So I'm hoping
Exactly.
I'm hoping that's not going to be the case with ISA reform.
Just before we finish off, because I think we've covered really good ground here. At the end of your report, you did just mention you mentioned the lifetime ISA, which I think I rate the lifetime ISA. I think it's a misunderstood product. I think it's under marketed by the government, and I think more people could be taking advantage of it. It doesn't solve the housing issues that we have, but it does help some people. And I will speak from the experience of myself and my partner, now my wife. We use lifetime ISAs to get on the ladder, and we got on the ladder probably quite a lot earlier than we would have done, because we got the best part of I think it was probably like $6,000 of extra top up, because we'd saved into them for a few years, and it just made it a lot quicker. There's problems with the lifetime ISA though, and you guys have got some solutions for that. I mean, let's run through it quick, because I appreciate we've been chatting a little while now, but there's some interesting stuff in there. So tell us.
Yeah, hopefully we haven't lost everyone so far, but we'll see. The lifetime ISA, as you say, a good product particularly for those who are using it for a first home. And I think part of that challenge around the marketing of the product and the explaining of it is some of the design features, principally the fact that there's this 25% early withdrawal charge, which means that you might get less back than that upfront bonus that you receive. So that's made it quite a difficult product, I think, to market generally, because you have to wrap it around with risk warnings, and particularly if anyone was going to try and market it to a self-employed worker as an alternative to a pension, because actually it is potentially quite attractive for that segment of the market, but that early withdrawal charge just makes it a bit more difficult. So we've suggested, the government, as many others have suggested this as well, reduces that early withdrawal charge from 25% to 20%. So it's just aiming to take back the value of the bonus if you use it for anything other than a first house purchase or access it from age 60. The government actually did that during the pandemic, during a period of when lots of people were potentially facing financial emergency. It would make it much simpler to explain the benefits of the product to people if that early withdrawal charge was 20%, and it would come at very, very little cost to government. We also think that property purchase price needs upgrading, so it's £450,000 is the limit at the moment. Clearly, we've seen house price inflation during that period, so you'll know Ed, that £450,000 sounds like a huge amount of money, but in London, certainly that's not going to buy you a huge amount, particularly in certain more well-to-do parts of London. You wouldn't be able to buy a property for £450,000. So increasing that to reflect the fact that generally house prices have increased, I think will be a sensible move as well, and it would be a good way for the new government to show that it's on the side of younger people who are trying to save for a first home, because I mean, yeah, you'll know, and I certainly know as well, it's incredibly difficult to do it unless you're lucky, in inverted commas, in that you inherit a load of money from a dead grandma or something like that. To save the deposit to get on the housing ladder is incredibly challenging, and with property prices increasing and what we've seen to mortgages, it's even more difficult. So it would to me that it seems like a bit of a no-brainer. It would be it would just be sending a signal to younger people that actually the government hasn't completely forgotten about their interests and is trying to at least create a small product that can help them on the way to buying a first home.
Yeah, I think we just ultimately, I guess, we all know what the answer to that crisis is building more homes, and I think ultimately the thing that we don't want is the current government falling into the trap that the last government have had, which was, let's just tinker with the demand and not actually do anything on the supply of housing and that kind of thing. Again, another big issue that I think we'll have to probably actually spend quite a lot of time waiting to see what happens. Although I will say, actually, we have a new housing estate going up near here, and it's amazing because it spends years in development, kind of doing whatever, and then as soon as the actual approval there's like 3 houses have gone up with roofs on already. They take like 6 weeks to build the actual house. It just makes you suddenly realize, God, this entire system is absolutely mad, because it doesn't take that long to build a house. It's completely crazy. Anyway, that was a bit of an aside. Tom, is really interesting. I mean, I must say, I find myself breaking out in agreement. Chris, I don't know. I would imagine you're probably similar.
Yeah, very similar. It's line in the sand time. Let's have a rethink and make this easier for everybody. Bottom line.
Yeah, it's that KISS, keep it simple, stupid, isn't it? At the end of the day. Tom, thank you very much for joining us. Really insightful. And Chris, thanks as ever for joining me. Everybody, you can catch us on Spotify, Apple. We're on YouTube and TikTok now because we're cool. And obviously, you can check everything out on the Mouthy Money website and the newsletter every week. So, gents, thanks very much again.
Cheers, thanks, Ed.
And I will hopefully speak to you all again soon. Thank you very much, and goodbye.